Right. Good evening, ladies and gentlemen.
Good evening, Mwalimu.
Thank you very much, Rachel. I hope the others can also hear me. Betty, can you hear me?
Yes.
Betty hasn't talked, but I hope you can hear me, and Adi as well. I hope you can hear me. Yeah, let me hope this is where we had stopped on Tuesday. Could I have somebody confirming that this is where we had stopped? Somebody?
Yes, I confirm.
Right. Yeah, so we then start on something which we call scenario analysis. And this is still to do with project evaluation. You know, all along we have been discussing evaluation of projects based on NPVs, based on the internal rates of return and other measures. Another way of doing project evaluation is under the concept of what we call scenario analysis. Yeah. So being something which also you have touched on before, is there anyone remembering what a scenario means? When we talk of a scenario, what are we referring to? Anybody? So again, with respect to a project, what does a scenario mean? All right. I don't look at scenarios in terms of a scenario. I look at it in terms of a possible outcome. A possible outcome of a project. Of a project. And why we want to look at scenario analysis is because normally, you know, when we talk of projects, they are futuristic. And so you cannot be certain about what the outcome would be. You can only speculate and try predict. For this reason, it's normally important that you evaluate the various different possibilities in terms of the outcomes. The different possibilities in terms of the project outcomes are then what we call scenarios. I will continue that different scenarios are defined by, allow me to call it risk preferences, are defined by what I'll be calling risk preferences. In other words, a scenario shall exist depending on how much risk appetite one has. And this, of course, will vary from one person to another because we do view risk differently. If this is the case, ladies and gentlemen, then of course we'll have the different scenarios or the different possible outcomes. For this reason, continue that for this reason, the common categories, the common categories of scenarios include which common scenarios do we normally evaluate? One, there is what we call the optimistic. There is what we call the optimistic, same as the best. Alternatively, we can call it best scenario. Best scenario. And this scenario normally apply for risk takers. Risk takers are those who have very high appetite for what? Risk. They do not fear. They do not fear risking. They do not fear risking. You know, look at, for example, people who engage in betting. They believe that like putting their 50 shillings would, for example, win them millions of shillings. You know, that is being too ambitious. In that case, we say that you are being optimistic. You are being optimistic. So such people, they look at what is the best possibility in terms of what could happen. Their best possibility is earning those millions from staking 50 shillings. So risk takers. The second scenario is the extreme opposite, those whom we call the pessimists. So that we have pessimistic, we have pessimistic, we have pessimistic. The pessimistic scenario is also called the worst possible scenario. So it's also called the worst possible possible scenario. Allow me to explain that this is normally for those who fear risk. This is normally for those who fear what? Risk. You know, there are those who are risk averse. We also call them those who are risk averse. Those who are risk averse fear risk. And for example, you cannot find them easily betting. Let me ask, by the way, in general, between men and women who are risk takers, and I'm saying in general, yeah? I don't mean all. All is not a possibility. In general, between men and women who take risk a lot, who risk a lot. Let me talk to Bruno. You just joined the class. Between ladies and men, who do you think risk a lot, Bruno?
Men.
Men. Betty, what do you think? Who risk a lot, Betty? Betty, who do you think risk a lot between ladies and men? Yeah, Betty talks of women. Betty is talking about women. Rachel, who do you think risks a lot, Rachel?
Men.
Men. Saadia, who do you think risk a lot between men and women?
Men.
Yeah, men. So it's a proven fact scientifically, yeah, that men tend to be more risk takers compared to women. This is proven. But like I've said, not all. So you'll find that a lot of times men will be optimists, whereas women will be pessimists. So women tend to look at what is the worst possible to happen. They tend to look at things in the negative. While for the men, despite the possible negatives, they look at what is the best possibility that could occur. So apart from the two extremes, the best and the worst are possible, we have those who are in between, those who combine these two tendencies. They take risk, but then again, not so much of it because they still fear the same risk. These people combine the two characteristics, and so we have a third category that we call the expected scenario. This could also be called base. Sometimes we could also call it normal scenario. Normal scenario. So what scenario analysis as a concept require is that as you determine the result of maybe a project, look at such results under each of these categories or these scenarios. What is the result of a project, for example, when you are being too optimistic? Then what is the result of a project if you are being a pessimist? And what is the normal, what is the expected possible result of the project? And when I say as you determine result, by result, I mean you could be computing something like NPV. You could be computing something like IRR, or you could be computing something like what? Profit. As you then compute such, you will be computing them comparatively under the different what? Scenarios. How much is the NPV when you are too optimistic? How much is it when you are being a pessimist? And how much is it when you are keeping it normal? Let's do this. Let us look at that next sheet, the one which I've labeled scenario analysis down there, this one. And let's be looking at that past paper what? Question. Let's look at that past paper question. So this had been set in April 2023. It was actually question number 21. So please look at it. So read through it. I could give you 2 minutes. 2 minutes, read through the question before we can look at it together. All right, so the question talks of the company is called 𝗬𝗏𝗯𝗔 Limited, who plans to invest in a 5-year project. This was in year 2024. So, however, the information on the project is not reliable. For lack of reliability, the company would wish to carry out what we are calling scenario analysis. And then we are told that the following data is available given 3 scenarios. The optimistic and pessimistic scenarios reflect the percentage variance from expected. So when you look at this provided info, we have cash flows, and these cash flows have been provided for the expected what? Scenario only. For the other 2 scenarios, the optimistic and pessimistic, we are being told that these percentages are the variances from what is expected. So if what is expected is this, for the other scenarios, we expect these other what? Variations. Apart from the cash flows, we are given capital allowance, we have inflation rate, and then we have taxation rate. The additional information is very key. Number 1, the inflation rate applies to revenues, the direct costs, the incremental fixed costs, and then the working what? Capital. We are then told that working capital will be recovered at the end of the what? The project. Now, you should not be told about this statement. It's always sweeping or general that if you have working capital, at the end of the project, you recover it, you receive back now that money, which means that as you carry out the process before end of it, you'll be spending money on working capital. But then at the end of the project, when the project is over, the working capital is received back. So you recover it. That's what the question is talking about here. So I'm saying you don't need to be told this. Please know from today that whenever you have working capital, you must recover it. Now, note number 2, that the revenues and costs arise from year 1. Number 3, that capital allowance, and for the first time we are meeting this thing, that capital allowance rate is on reducing balance basis. Then number 4, that tax will be applied on the gain or loss on disposal of the asset. And then number 5, that the weighted average cost of capital for the company, we have what percent? 15%. The question then requires, now look at how the question is framed, that compute the following for each of the 3, meaning that each of the 3 scenarios separately. Can you compute these 2 things? One is NPV, and then number 2, we have the internal what? Rate of return. Let's down here have the solution to this question. Let's have the solution to this question. Before we can do anything, I think, let me call it working 1. Let me call it working number what? 1. Now, ladies and gentlemen, let's appreciate this. That for these cash flows, you know directly the question gave us just for scenario 1, just for the expected scenario. We don't have them for the optimistic, neither do we have them for the pessimistic. So the first thing that let us do, let's get these cash flows for these other 2 scenarios also. And so down here, I'll say that working 1 is about cash flows per scenario. The cash flows per scenario, the cash flows per what? Per scenario. Now, which cash flows do we have? The first one is this initial investment. And then I'll copy them to the last one. The last one is the incremental fixed what? Now cost. The question has given us the cash flows for the expected scenario and the initial investment. The initial investment is this 100 million. So that in the same manner we copy for the other cash flows. You know, we also have the second scenario, the optimistic, and then the third scenario, pessimistic. The third scenario, pessimistic. So how do we get, for example, this initial investment for the optimistic scenario? Now, please listen to this. Here, we are told that the percentage variance is minus 20%. What does minus 20% mean? Are we to reduce this 100 by 20%? Or are we to increase it by 20%? Minus means you reduce or increase.
You reduce.
You reduce. So you reduce this 100 million expected by 20% for the optimistic scenario. And then for the pessimistic scenario, you know, it's now plus. So you increase it. So what I'll do is to have let me insert a formula for this first one. That formula will just drag it to these other ones. For the optimistic, for example, the formula will be that we take this 100 million times, allow me to have an open bracket. So I'm inserting a formula which I'll just drag to the last one. I don't need to compute one by one. So plus, I'll say 100%, just type 100% plus 100% plus what? Plus, let's have this minus 20. Let's have that minus 20. So, you know, if you take 100% plus minus 20%, you remain with 80%. So we are looking for this 100 million times 80%. That's what I've computed here. So I close the bracket and then I press enter. So you can see that you end up with what? 80 million shillings. That means we have decreased this by 20%. Let's do the same thing for the pessimistic. Or rather, once we have computed this 80, you can just drag it to the last cash flow so that those things calculate automatically. The same thing for the pessimistic. I'll insert here a formula. The percentage variations are from what is expected. Don't forget that. Or even under pessimistic, I start with the expected of 100 million. So I'll say that times, again, the open bracket 100%, now plus, we now have this plus 30%. So I close the bracket, I enter, that's 130, so I've increased by 30%. So I drag that again to the last one. So I drag that again to the last one. So that we now have all the cash flows for the three scenarios, which are based on, we can now proceed to do what the question wants. And so, Saadia, are we together to that point?
Yes.
All right. If that is okay, then we can proceed to, you know, we have to compute this A and B for each of the three scenarios. Under scenario analysis, you analyze each scenario separately. Let me start with the first scenario, which is this expected. So allow me to say down here that we have scenario 1. Scenario 1 is the expected one, the expected scenario. The expected scenario. Now, how to compute what the question wants, we now know. And we've seen that when you have this kind of cash flows, you must first of all summarize them. Remember, for each of the periods in this project life, the project life we are told is 5 years. So we must first summarize these cash flows for those 5 years. For those 5 years, to get their net relevant, you know, which we have always seen is what we use to compute this part A and what? Part A and B. So the next thing to do is to have working number 2. Working number 2. In working number 2, what I will do is to look for what are the relevant. So what are the relevant cash flows over the project what? Life. The project life is 5 years. So we know that you must always, so in columns we'll have the periods, but then we know that you must always start from period 0. So period 0, you must always start from period 0. Then of course, year 1, the project life is all the way to period what? 5. So there. So I'll have them that way. I'll have them that way. So those are our periods. Now let's summarize the cash flows quickly, because for most of them we are used to them, and so summarizing them should not be an issue. The first cash flow we have is this initial investment. And allow me to ask, the initial investment is normally for which period? When do we normally invest this money? In which year? In which period?
Period 0.
In period 0, does it appear under period 0 as plus or minus?
As a minus.
As a minus. So you come to under period 0 and say that this equals negative. These are 100 million. So you must put the negative so that it becomes a minus. So negative 100 million is what we have under period 0 for that initial what? Initial investment. Now this is followed by which one? After the initial investment, we are told we have before tax residual value. So let's have the residual what? Value. The residual value normally apply for which period? Yes, Rachel? And is it as a plus or minus, Rachel?
The last year.
The last year is
It's
plus
a
or
positive.
minus?
Plus.
As a plus. So under year 5, you'll have that. So equal to this 20 what? 20 million. Please remember, we are looking at the expected scenario. Let me color that in yellow. Forget about the other 2 scenarios first. We must finish with this, which is expected, before we come to the other what? 2. All right. So after that residual value, we are told we have initial working capital. So I'll just call it working. I'll just call it working what? Now capital. Working capital. Now let's agree. Let's agree, and this is critical. You know, we are meeting this for the first time. So allow me to explain this very clearly. When the question says that this is initial working capital, 15 million, you know, it's more or less like this initial investment. So that when you have initial working capital, that also apply in period what? 0. That's an investment that you do. Remember, in period 0. So we make that payment in period 0. Why I've concluded it's for period 0 is because you are told it is initial. So under period 0, we'll have negative this 15. will have negative that what? That 15. Now, there's something else we were told about this working capital. Actually, two things. Come back to note number 1. Come back to note number what? 1. The question says that the inflation rate applies to 4 things: revenue, direct costs, and then the incremental what? Fixed costs, and then the working capital. What does inflation normally do to prices and costs? What is the effect of inflation on prices and costs? Somebody. What does inflation normally do to costs and prices? Does inflation increase or decrease prices and costs? Yes, Rachel?
It increases prices and costs.
Yeah, so inflation is a general increase in prices and what? Costs. When you are then told that inflation will apply to this working capital, it only means that inflation will increase this working capital from year 1 to normally the second last year. And I'll explain why. For the working capital, it's all the way to the second last year. I will explain why. So when you come back to this info, the inflation rate is here. This, you know, for the expected scenario, this is 5%. Optimistic will be 3, pessimistic will be 8. Normally, an inflation rate is per year, per annum. So that this 5% then apply per what? Per year. Now, we then have to take care of that inflation increment then from year 1 to onwards. Look here, ladies and gentlemen. The increment by inflation will be this 15 million in period 0. You know, that's what we started with. So that will increase by 5%. So I'll multiply by 5, I'll multiply by 5, I'll multiply by 5%. Now, listen carefully. I have not multiplied by 1 or 5%. I have not multiplied by 1 what? 1 or 5%. I am multiplying by 5%. Why? This 15 million apply in period 0. You can therefore not carry it forward to period 1, period 2, and so on. You know, it's more or less like this initial investment. It is exclusively for period 0. So even this 15 is exclusively for period 0. The only consideration, therefore, is that 5% what? Increment. So in period 1, that is 750. When I come to period 2, now look here. At the start of period 2, the working capital is now this 15 plus this 750. It is now that summation. That is now the total. That's now what you then increase again by 5% when you come to period what? 2. So that in period 2, we'll say that we take the sum of these two. I close the bracket and then times 5%. That's how you compute it. I get that. Now in period 3, the total working capital is now this summation. So this sum again times 5 what? 5%. So again sum of these 3 times now 5%. We get that. When I come to period 4, this again will be sum of now all this, and then times what? Now 5%. And that will be 868, now 218. There will be no increment in period 5. There will be no increment in period what? Period 5, no increment. So don't compute it as similarly in period what? 5. Now, so what happens to this working capital in period 5? Come back to this statement which you are told here, that working capital will be recovered at the end of the project. What does that mean? That's why in period 5, I will not have the same increment. So we have been spending this money from period 0 to period 4. Negative means we have been spending it. The question says in the last period, at the end of the project, we recover the money. Recovering the money means that you receive all these monies back. Because you are receiving back being a cash inflow, then that summation will be a plus under period 5. How do I compute this sum as a plus? I just say that equal to, you say equal to negative first, then you say sum of, then you say sum of all this, then you say sum of all that, then you say sum of all that, and then you close the bracket. If you press enter, you can see we have positive 18 million. Yeah, so that Saadia, is that okay? Saadia?
I'm doing it.
You are still doing it. Betty, is that okay? Betty, are we together to that point?
Yes, we are together.
Okay, Bruno?
Yes, we are together.
Yeah, so Rachel, you will not ask you because at some point you disappeared, eh?
Yeah.
At some point I saw you disappear. So that is it for the working capital. The next cash flow we are told is these revenues. And actually we can have the other two costs also. You know, we have the revenues and the direct costs and the incremental fixed now costs. Remember that revenues and costs are then incurred and earned from period 1. So the revenues and costs originate, remember, from period what? 1. And this you are told clearly in this note number 2, that the revenues and costs, they arise from year what? Year 1. But of course, again, you don't need to be told that. That you must be knowing. You know, in period 0, we only invest. So we start doing business, come period what? 1. So the revenue for period 1, remember, is this 140 million. So I'll have that 140, that which we had here. And then the direct cost period 1. So revenue should be a plus. That you have to remember, revenue is normally a what? A plus. The costs are negatives because they are outflows. So the direct cost will equal negative this 60. And then similarly, copy for the incremental fixed. So similarly, copy for the incremental what? Fixed. But you know, these are just for period 1. What about period 2 to 5? Again, in note number 1, you are told that the inflation rate applies to revenues, the direct costs, and the incremental what? Fixed cost. So these 3, we then adjust them for inflation. Inflation, we already saw that we have 5% for the expected scenario. So we need to increase them by that inflation of now 5%. Let me start with this revenue. You know, this will be 140 now times what? Please listen carefully again. This will now be times 105%. These ones have not originated from period 0. So you cannot look at just the increment only. You now carry forward these initial amounts to the other years. So you multiply by 1 or what? 105%. That revenue increases to 147 million. Because the same percentage apply for even the two costs, I just drag the formula for this 147 to there. So that way, I have the figures for period what? Period 2. As we go to period 3 and onwards, you know, we'll keep increasing by 5%. You don't need to keep doing it one by one. You can just drag the formula for these figures for period 2 to the last year. Just drag all of them, the 3 of them, so that way, we have all those figures until year what? Year 5. Rach, are you saying something?
No, I'm just wondering why the working capital I've dragged, but it's giving me something else.
You disappeared. That's why. That's computed differently.
Oh, okay.
Not computed. That time you disappeared is when I realized you disappeared, so I knew you were not there. Okay?
My network was the issue.
Yeah, so Rachel, what happens here? For the working capital, you see this one originate from period 0, yeah? So you can't bring it to period 1. So in period 1, all you consider is just 5% of this. Is that okay?
Yes.
Now, when you come to period 2, look here, when you come to period 2, you now take, you know, total working capital will be this plus this. So the increment by 5% is 5% of this summation.
Okay.
Tunaelewana?
Yes.
So you can't drag this formula. This one you must compute one by one. Because look at like now period 3. You take that summation, you multiply by 5%. When you come to period 4, again, you take the whole of that times 5%. Then in period 5, you know why this is a positive, isn't it?
Yes.
Yeah, it reverts. Reverting means you receive back the money, okay?
Yes.
So it's a plus.
Okay. Thank you.
Well, Karibu. So which other cash flows do we consider relevant here? Let's look at this note number. Let's look at this note number 3. You know, we are told that capital allowance rate is on reducing balance what basis. And then note number 4, that tax will be applied on the gain or loss on disposal of the what? Of the asset. Now, I want you to remember this. At the end of the project, the asset will be sold. Look here. You know, we have this residual value. At the end of the project, the asset will be sold for this 20 million. Sale of an asset is what you call disposal. Don't forget that. Sale of an asset is what you call disposal. So that normally when we dispose an asset, we know even from normal accounting that when you dispose an asset, you dispose for a profit or for a what? For a loss. You profit or lose on asset what? Sale. The question says clearly that any profit or loss on the asset sale will attract taxation. Tax will be applied on gain or loss on disposal of what? Now the asset. The question is, how do we compute the gain or loss on disposal of what? Now the asset. Gain or loss on asset disposal is normally the difference between the disposal proceed. When you take the disposal proceed, in this case, the disposal proceed is 20 million. This one here, we will dispose the asset for 20 million. So the difference between the disposal proceed and the difference between the disposal proceed and what? and asset value. And asset value at the time of disposal is what we call the gain or loss on what? On disposal. Look here. Because we shall subject the gain or loss on disposal to tax, the asset value to work with must be the value for what? The value considered for tax must be the tax value. That's what I'm saying. So the question is, we know the disposal proceed as this 20 million. What we don't know is what is the tax value for this asset at the time we are disposing it. When are we disposing it? We are disposing it at the end of year 5. So what is the tax value of the asset at the end of what? End of year 5. How do we compute the tax value at the end of year 5? Allow me to skip a few rows here and have working number 3 down here. So working 3, let me talk of, we are looking for the tax value at end of year what? Year 5. The tax value at end of year 5. Now, we start from year 1. What is the value of the asset at start of year 1? So at the start of year 1, we have cost of the asset brought forward. What is the cost of the asset? I'll work with the same columns for year 1 to 5, so that year 1, what have I done here? So what is the cost of the asset at the start of year 1? The cost of the asset at the start of year 1 is the initial investment. What you invest initially is what you incurred to purchase the asset, remember, yeah? So the value of the asset at the start of year 1, cost brought forward is this 100 million. Work with the same columns for year 1 to 5. So cost brought forward is 100 million. You must depreciate the asset, remember, but you know KRA does not consider. KRA does not allow us to depreciate an asset. KRA allows us, we take into account what we call capital allowance. So instead of depreciation, KRA allows for capital what? Capital allowance. So when you come back up here, you know we are told that we have capital allowance, the rate is 30%. So the capital allowance for year 1 will be this brought forward figure times 30%. So you say times 30 what? 30%. 30%. That will give us 30 million. The value of the asset at the end of year 1, look here. The value of the asset at end of year 1 is this 100 million minus this 30. If you had 100 million at the start and then you depreciate for tax by 30 million, the value of the asset at end of year 1, we have 70 million. Normally for taxation, when you take cost and you minus capital allowance, the remaining value is what we call the written down value. You say carried what? Carried forward. The cost of an asset minus the cost of an asset minus capital, accumulated capital allowance. Allowance is what we call the written what? Written down value. Now let's agree. When we then proceed to period 2, the starting value for this asset equals this carried forward written down what? Down value. So you start period 2 with that 70 million. We shall then continue computing these things until the last year. The written down value at the end of year 5, there, that's what we are looking for. What is this value at the end of year 5 here? So what is that value? at the end of year what? Year 5. So let's agree that we have to compute these things until the last year, but you don't need to compute one by one. Let me show you how to get all of them at once. If you want to get all of them to the last year, do this. Highlight this 70, drag it to the last year, then highlight this 30, also drag the formula to the last year. Then also highlight this 70 carried forward, also drag it to the last year. That way, you have everything. So that the value we are looking for is that 16 million point 8. Is that 16 million point what? 0.8. Is that 16 million point 0.8? Or is that 16 million point what? 0.8. So is that 16 million 0.8? Or is that 16 million point 0.8? Or is that 16 million point 0.8? So remember, we are to sell the asset for 20 million shillings. At this time we are selling it, the value would be 16.8. So we are selling it for more than its value, meaning we are profiting. Let's determine the disposal profit. Let's determine the disposal what? Profit. The disposal profit will be, we are selling it for this 20 minus the value is this 16. So we will profit by 3.193. We will profit by 3.1993. So we will profit by 3.193. So are we clear on how we arrive at that disposal profit? Bruno?
Yes.
Is that clear?
Yeah.
Betty?
Yes, very clear.
All right. So what happens is this, you know, when you make such profits, KRA will come for you that they want their share in terms of tax on that profit. When you profit, KRA does not leave you alone. We know how 𝗂𝐧𝐭𝐬 is very serious with tax collection issues. So KRA must come for you that out of this, we want our share of what? Tax. So on this, we must compute tax. We must compute now tax on the profit, but this is what I'll do, yes? The tax on this profit, you know, we pay to KRA. And that tax is a cash outflow, meaning it is another relevant cash flow to consider here. So I'll say that one more relevant cash flow to then consider is the tax on disposal what? Disposal profit. The tax on disposal what? Profit. So, you know, this is happening in year 5. So we'll have the tax under year what? Year 5. So this equals what? This profit times tax is 30%. We were told up there, but because we will pay out this money, you know, this will be a cash outflow, we must make it a minus. So you put minus before any of these cells. So I can put minus before 30. So that comes to minus, the tax we'll pay is 957, now 900. The tax we'll pay is 957, and then what? 900. 957, and then 900. Okay, so let me hope that's okay. Now, just one more cash flow. One more cash flow is this. Look here. This company will be doing business. They'll be trading, so that from the trading, they'll be making that sales revenue. The sales revenue, for them to make it, they will be incurring these costs. So they're in business, meaning that they must be making some profits from trading. When you take this 140 minus these costs, you'll have profits. So that profit which they make on doing business, you know, again, 𝐂𝐬 must come for you. The moment you profit, again, 𝐂𝐬 will say that we want our share of what? Profit. What's your corporation tax? The tax on trading profits is what we commonly call corporation what? Tax. So one more cash flow to consider here, after this tax on disposal profit, is the corporation tax. Because that tax you must pay to 𝐂𝐬. So it's a cash what? A cash outflow. So the question is, how much is the corporation what? Tax. The corporation tax you normally compute on I'll have working number 4 here, and I'll call this one, for you to compute corporation tax, you must determine your taxable what? Profit. What is the taxable profit from trading? And let's agree, the taxable profit is, please again listen to this, this is critical. It is this revenue minus these two costs. So I'll very simply add them. But one more expenditure allowed for tax. This is critical. One more expenditure allowed for tax that you must also minus from taxable profit is normally this capital allowance. So not only do we consider the two expenses, but also the capital what? Capital allowance. How do I compute this taxable profit? I'll say that this equals the sum of these three. You know, the sum of those three will mean that you have 140 minus 60 minus 40, because these are already minus. So you just add them. That gives you the difference. But from that difference, further minus, so close the bracket, minus this capital allowance. Close the bracket and then minus that capital allowance, So if you minus that, the taxable profit comes to 10 million. So it comes to 10 million. And so similarly, compute for the other year. So just drag the formula to the last year. So it is now on these profits that 𝐂𝐬 will take their share of tax of 30%. So the corporation tax that we pay is that taxable profit times what? Again, tax rate, which is 30%. But again, the taxation, we pay it out to 𝐂𝐬, meaning it's a cash outflow. That means we must make this thing a minus again. So I put minus before that 30. So that comes to minus 3 million. And again, similarly, can you compute to the last year? Can you compute to the last what? To the last year.
Mwalimu,
Yes, yes.
kindly repeat on how you've computed on corporation tax.
Corporation tax, did you understand how we got this taxable profit?
Yes.
No, so it is just the tax times 30%. It is just the profit, I mean, times 30%.
Oh, okay. Okay.
All right. All right. So with that, we are done with the relevant cash flows to consider. We can then summarize them for each year, so we can then total them. So that this is what we have been calling the net relevant cash flow. That's what we call the net relevant cash flow. That's what we call the net relevant cash flow. So that's what we call the net relevant cash flow. So that you just total them downwards. And so those are the amounts, those are the cash flows. Based on these cash flows, we can now answer part A and answer part B. We can now compute the value for the NPV. Again, we can compute the value for the IRR. All those you now know how to compute. So all those you now know how to compute. The NPV, for example, will equal NPV in bracket, the discount rate we were told is what percent in this question? 15, eh? So cost of capital, we have 15%, comma, the values period 1 to 5, I close the bracket, and then plus this initial. So NPV comes to 21.9 million. NPV comes to 21.9 million. The IRR is equal to IRR in bracket all the values, all the cash flows. And so that's it. So 22%. 22%. 22%. So is there any question on that? Any question? All right, so if there's no question, then that is it for, let us not forget, that we are doing scenario analysis, and so far we have only done scenario 1. So we have only done scenario what? Scenario 1. So that means that this question had 20 marks. So far you've only earned a third of the marks, because you have 3 scenarios. So you have to repeat the same procedure for the optimistic scenario, because the cash flows are now these ones, and also repeat the same procedure for the pessimistic scenario, because the cash flows are now these ones. So for the question to be complete, you must have the same workings for all the 3 scenarios. The beauty of it is that once you have done the first scenario, the other scenarios, you should be able to do them within like 4 minutes each, because it is just about changing what? Figures. Instead of this 100 million for the initial investment, optimistic scenario has 80. Pessimistic will have 130. So what I'll do, allow me to very quickly run through the optimistic scenario, scenario 2, then I will let you guys do scenario 3 as part of your revision later. But in exams, you make sure you finish all of them. So allow me to very quickly run through optimistic scenario, then I let you do the last one on your own. All right. So let me say here that we then have scenario 2. We then have scenario 2. This is now optimistic. Why I'm saying you can do this in 4 minutes is because the first thing to do, because the workings are similar, just copy all those workings, copy all of them, copy all of them. So what we'll do is just to change the figures, what they should be appropriately. So I don't want these figures for the other scenarios, so I'll just delete them. I'll just delete them. So I have the same arrangement for my workings as I had before. So I want to now have the figures for the optimistic scenario. The initial investment is, this is now equal to -80. The optimistic scenario has 80. Residual value under period 5 is a positive. We have this 22 million. The working capital, the initial one under period 0 is negative, this 14 to 50. And then the working capital, we know we should adjust by inflation to year 4, then it reverts in year 5. The inflation rate under the optimistic scenario is 3%. Please make sure you work with the right percentage for that inflation rate. So year 1 will have this initial one times 3%. Then year 2 will have the sum of that plus that times 3%. Then year 3 will have sum of all these again times 3%. And then year 4 will have the sum of all this again times 3%. In the last year, we said that this thing reverts, so equal to negative sum of all this. So that's it, plus 16 million. Now, revenue period 1 for the optimistic is this 154 million. The direct cost is negative this 48. And then the incremental fixed is negative 36. These ones we said you adjust by just the inflation. So revenue is that 154 times now 103%. Is now times 103%. The same apply to the two costs. And then I drag the formulas to the last year. You now know what should be done, so I'm moving quickly. So I then have the two taxes to compute. For me to compute the two taxes, remember, I must have these workings down here. To get the tax on disposal profit, I first compute the tax value of the asset at end of year 5. So at the start of year 1, the cost brought forward is 80, the initial investment. Now allow me to explain this because this is oftenly confusing. Look here. When you come back to this original data, the capital allowance, the expected, we were told we have 30%. And then under optimistic and pessimistic, we are told N/A. N/A generally means not applicable. What is not applicable? Is it that the capital allowance is not applicable, or what is not applicable? We were told here that the optimistic and pessimistic scenarios reflect the percentage variance from expected. So when you are told not applicable, there is no variance applicable for the two scenarios, meaning for the two other scenarios, use the same rate as the expected. So use 30%. So don't confuse this to mean that the capital allowance generally is not applicable. So we still, for the capital allowance down here, work with 30%. So 80 million times 30%. That will be about 24 million. And then the carried forward written down value is 80 minus this 24, that's 56. So at the start of period 2, I start with that 56. I taught you already how to get the values to the end of the project. So I highlight 56, drag the formula to the last year. 24, I drag the formula to the last year. 56, again, I drag the formula to the last year. So at the end of the project, the value of the asset is now this 13.44. Whereas we are to sell it for residual value is now 22 million. So residual value is this 22 million. The value is 13. Again, we have a profit on sale. So the profit on sale is this 22 minus this 13. So the profit on sale is 8.5. Being a profit, remember you are taxed on it. So that's why we have this tax on disposal, what? Profit. So the tax here will be this profit times 30%. Tax is 30% because it is tax that will pay, it is a minus. So I make it minus that 30%. So 2.5. Lastly, I have corporation tax. For the corporation tax, we must first compute the taxable what? Profit. How did I say we compute like for year one? You take the sum of these three first, revenue and the two costs. But another allowable expenditure that minus is this capital allowance, so minus that 24 million. So the taxable profit year one is 46 million all the way to the last year. So similarly compute for the last year. So on this profit, we now compute this corporation what? Tax. Year one will be this corporation tax times minus 30%. Minus 30%. So year one will have 13.8 million. Similarly to the last year, so that way I am done with scenario what? 2. So once you've done scenario 1, now compute kila kitu mzuri. Doing scenario 2 should not be an issue. Should not be an issue. So that I just add them downwards. Those are the cash flows. Now for scenario 2. So again, I can compute my NPV. So equals to NPV. The rate is still 15%. Cash flows period 1 to 5. I close the bracket plus. Now this is 94. So that comes to about 109 million. And then the internal rate of return will equal the IRR in bracket all this. I close the bracket. Now that's it. 55%. So that way I have done scenario 2 also. You just change the figures for scenario 2. So in the same manner, I want you guys to do scenario 3 on your own. This one I'm not doing with you. So this one you do on your own. So scenario 3, which is the pessimistic, the pessimistic scenario. This one you do on your own. This one you do on your own. You do on your own. Bruno, are you able to do scenario 3 on your own, Bruno?
Yes.
You are. What about Betty? Betty?
Sorry? Yes, yes.
Are you able to do scenario 3 on your own?
Yes, I can.
And Saadia?
Yes.
Yeah, Rachel, you are having serious network challenges today. She's again disappeared. Eh? All right, so finish on that scenario 3. Finish on that scenario 3. Remember, when we meet in the next class, you will have done this. Eh? We shall begin on the last discussion, number 8, under financial management, which is what we call the loan amortization, the loan amortization schedule. The loan amortization what? Schedule. So in the next class, we shall discuss on, we need to have.
Yeah. Yes.
Did you see them? The theory notes, the theory handouts which I sent. Did you see them?
Yes.
Yeah, please, disome pole pole. Be looking at them progressively. I think I'll start giving samples of multiple choice questions somewhere mid-February, after you've read a bit of those handouts, so that you see how the multiple choice questions are set. Eh? I'll give a few for the past exams, maybe for some 2 or 3 exams, plus solutions, plus others which I've been able to compile on my end to help you in revising on those notes. I will
So
be
a
stopping.
question, the theory the theory part of that section 1, the multi-choice question.
The theory is purely for section 1, the multiple choice, the first 20 marks.
Okay.
Yeah.
Okay.
Otherwise, section 2 is what we concentrate on in class, this 𝐂𝐳𝐵. This 𝐂𝐳𝐵 that we are concentrating on in class is the section 2. It accounts for 80%. Sawa sawa, Saadia?
Yeah.
All right. I hope there is no other question because I'll be stopping there. Enjoy the rest of your week and see you guys next week.
Thank you.